Hey folks, hope you all are doing well. I'm Karan Bandal from Econosite, your weekly wrap on economic news from India and around the world. So let's get started. There is a major shift underway in manufacturing for the US companies. A new survey was conducted by SAP. SAP is a German software giant, a global leader in supply chain software with approximately 23% market share. Well, key findings from the survey are these. Even as we enter into the third year since the COVID pandemic hit, most businesses expect supply issues to persist going into 2023, meaning supply chains are still under stress. Supply chain rules have changed and we are in a post-globalization world now. Majority of the organizations, that is 52% of them, believe they need major supply chain improvements. And many US companies are now shifting from just in time to just in case supply chain model. What does that mean? Companies will carry more inventory and they will prefer use of more suppliers closer to the US as opposed to relying on Chinese manufactured goods. Reshaping the supply chain or establishing this new model of supply chain, that is just in case, this will come at a cost as companies gradually move away from cheap Chinese goods. But companies have plans to address rising costs in this upcoming model of supply chain. Majority of companies will go for wage freeze or hiring freezes, followed by job cuts, and the last resort, passing on the cost to consumer by increasing the selling price of goods and services. So I think as consumers in the US, we need to understand that prices will remain elevated in the near future, but supply chain as a whole will be more resilient and reliable. Next up, on a similar note, who wins from the unraveling of Sino-American trade? Article states that a series of shocks, COVID pandemic, economic pain that ensued, supply chain disruptions, worsening US-China relations, a series of shocks is transforming international commerce. Deeper shifts in global trade patterns are taking place. Actions that are also contributing to this shift are tariffs on imported Chinese goods placed by then President Donald J. Trump in 2018, Joe Biden's recent ban on advanced semiconductor technology export to China, and subsidies worth hundreds of billions of dollars for investment in domestic manufacturing in the US. Global trade in goods made an impressive comeback last year after COVID pandemic induced downturn in 2020. Last year, value of global trade as a share of world GDP rose to its highest level since 2014. But not all trade routes are flourishing. According to American data released on November 3rd, US's imports have risen by a third since 2018. Dig deeper and you see different world regions share an uneven gain in this rise. American imports of Chinese goods stand just 6% above the level seen 4 years ago. American imports from EU up by just 12% since 2018. It seems that friendshoring is happening, but not at a grand scale. Imports from Canada up by 39% and Mexico up by 34%. Now look at Asia. American imports from Vietnam are up by a whopping 170%. Bangladesh and Thailand up more than 80%. Exports to America from India and Indonesia are up by more than 60%. As a result, we see China's share in American imports dropping from 21% in 2018 to 17% in 2022. Now this shift or disengagement is happening on Chinese side as well. Over the first 9 months of this year, the share of China's imports coming from America fell by 2 percentage points compared with the same period in 2018. The share coming from the EU declined by a similar amount. On the other hand, China's share of imports from ASEAN nations grew by 2 percentage points. ASEAN stands for Association of Southeast Asian Nations. a group of 10 countries. So, China is importing less from the West and more from Asia. It appears that the West and China both are decoupling from each other. Cultivating new sources of goods or components takes time and investment. So, the shift in the trade patterns now visible in the data reflects the choices firms made well before this year's geopolitical disturbances. This shift may only accelerate from this point on. Therefore, an even larger share of value in Asian supply chains may concentrate outside of China rather than within it. Let's look at one of the winners of this shift more closely: India's coming decade of outperformance. This article is written by a chief Asia economist at Morgan Stanley. In the world of investing, investors continually look for the next big thing. For the past 20 years, and from a macro standpoint, that story was China. Over the next decade, while US and China will remain just as important to global investors, this chief Asia economist thinks that India will feature more prominently on their radars. So, why is that? Let's try and understand. The key lies in the size and scale of India's opportunity set. They forecast that India's economy will more than double in size from current $3.4 trillion to $8.5 trillion over the next 10 years. In the medium term, by 2027, India will be the third largest economy. That means India will add more than $400 billion to its GDP every year. Only US and China surpass that number. Speaking of stock market or capital market, market capitalization for a country is directly related to the size of its economy. The writer's colleague Ridham Desai projects that India's market cap will rise from $3.4 trillion to $11 trillion by 2032, the third largest globally. So, what are all these rosy projections based on? There has been an ongoing confluence of favorable domestic and global forces. The most important change domestically is the shift in policy approach away from redistribution and towards boosting investment and job creation. The evidence being introduction of goods and services tax that created a unified domestic market, corporate tax cuts, and production linked schemes to incentivize investment from both within and outside India's border. Overlay this with the emergence of a multipolar world where companies are diversifying their supply chains and India emerging as destination of choice. India already has a high global market share in services exports, and its lead has only increased since the onset of the pandemic as corporates became more accustomed to remote work. India is now making a concerted effort to attract investment to boost manufacturing exports. This will draw more employment into formal sector, raise productivity growth, creating a virtuous cycle of sustained growth. Against this backdrop, the author thinks that India is entering a phase where incomes will compound at a fast rate on a high base, meaning India took 31 years since 1991 to raise its GDP by $3 trillion. According to the projections, it will take just another 7 years for GDP to grow by an additional $3 trillion. India's GDP today is where China's was in 2007. But India's working age population is still growing, which will give India a longer growth runway. Author projects India's real GDP growth will average 6.5% over the coming decade, while China's will average 3.6%. China's growth was propelled by a build out of hard infrastructure like roads and railways. India is admittedly playing catch up and is now making concerted efforts to raise public expenditure on infrastructure. We did talk about this in many of our previous weekly wraps. But where India leads and stands out is in its developmental approach towards digital infrastructure. Unlike other economies where private networks have taken root, India has led the world in building public digital infrastructure. This is based on India's unique digital identification system, Aadhaar. Further layers are being built on this foundation, which will ease the cost of doing business. India's digital payment stack is already much superior. The new ONDC, that is Open Network for Digital Commerce, set up by the government, facilitates e-commerce transactions across a network of buyers and sellers. In other words, a company like Amazon will have difficulty in establishing monopoly in e-commerce market in India and exploit small suppliers on its platform. So, there is a lot of potential in the India story. In a world starved of growth, India offers a compelling opportunity for multinationals and global investors. So, manufacturing companies in the US are changing their supply chain model to just in case, reducing their reliance on Chinese goods. This has already been partly validated by the recently released American trade data, where we see American imports of Chinese goods have fell and other Asian economies have benefited. One country in particular finds herself in a Goldilocks spot, India, where shift in global supply chains, shift in domestic policy, and excellent demographics has a potential to provide strong tailwind towards its growth story for the next decade. We'll follow the progress right here and see whether India is able to grab this rare opportunity by the scruff of its neck. I hope you enjoyed this week's wrap. I'll speak with you again next week. Until then, take care.